Hey there, and welcome to the Property Wealth Podcast. Today, we've got a really exciting episode lined up for you. If you're looking to dive into the world of real estate investing, you're in the right place.
Absolutely, Sarah. In today's digital age, tools like Zillow and Redfin can really be game changers for investors. They're not just for browsing homes. They have some pretty nifty tricks up their sleeves.
Right. And we're going to unpack some of those tricks today. It's all about making those platforms work for you, not the other way around.
Exactly. We'll also touch on how to analyze properties effectively using these tools and share some insider tips on what to look for that could really boost your investment strategy.
Plus, we'll discuss how to avoid common pitfalls that many new investors fall into when using these platforms. It's so easy to get lost in all that data, isn't it?
For sure. And we want to make sure you come away with actionable insights that you can implement right away.
So whether you're just starting out or looking to refine your existing strategy, stick with us as we dive into the nitty-gritty of real estate investing.
Let's get started. Sarah, when we talk about platforms like Zillow and Redfin, it's not just about browsing listings. It's really about leveraging technology at a time when, things are changing so quickly in the real estate market.
Absolutely. And for folks over 40, those changes can feel daunting, right? Retirement timelines are creeping up, and suddenly, it's like, do I have enough?
Exactly. And inflation, too. It's been a hot topic lately. The cost of living is rising, which can really impact how we view our investments. People want to know their money is working for them, not just sitting there losing value.
Right. I had a listener reach out recently. She's in her early 50s, and she's worried that her savings won't keep pace with inflation. She mentioned how property could be an effective hedge against that.
That's a smart observation. Real estate tends to appreciate over time, typically outpacing inflation. But it's about making informed decisions. With tools like Zillow and Redfin, investors can analyze trends in real time, which is crucial today.
Can you give an example of how someone might use those tools to protect their wealth?
Sure. Let's say an investor. Let's call him Tom. He's in his late 40s. He's been looking at properties in his area using Zillow. He noticed that a neighborhood he's interested in had a significant increase in property values over the last 5 years.
So he's tapping into that data to see where he should invest next?
Exactly. Tom saw that the average home price went from, let's say, $300,000 to $400,000. By investing now, he can potentially ride that wave of appreciation. And he's also keeping an eye on rental prices, which have also been climbing.
Smart move. And for someone in that age bracket, that could mean more financial stability as they approach retirement.
Right, and let's not forget about the emotional side of things, too. There's a certain peace of mind that comes with knowing you have assets that are likely to appreciate. For someone like Tom, it's not just about the numbers. It's about securing a future for his family, and maybe even leaving a legacy.
Speaking of family, there's this big conversation around wealth transfer nowadays. More than ever, people want to ensure their kids or grandkids are set up for success.
Absolutely, and real estate can be a great vehicle for that. If Tom buys a property now, he could potentially pass that down. Imagine his kids benefiting from the appreciation, or even using it as an income-generating asset later on.
It's like planting a seed now so it can grow over time.
Exactly. And when you think about current economic trends, we're seeing shifts in the market that could create opportunities. For instance, some areas are seeing lower inventory, which typically increases demand.
So, investors who are savvy with these tools can find those hidden gems before everyone else catches on?
Yep. And using features on Zillow or Redfin, they can set alerts for specific criteria, like price drops or new listings in a desired area. This is crucial in a competitive market.
That's a game changer. It's like having a virtual assistant working for you 24/7.
Exactly, and it helps streamline the process. Plus, with the ability to analyze past sales data, investors can make more educated decisions.
I think it's also about the confidence it gives you. Knowing you have access to the same information as the big players in the market can be empowering.
Definitely. And it's not just about finding a property to buy. For some, it might be about selling their current home to downsize or move to a more desirable location.
That's true. The ability to see what similar homes in their area have sold for can really help them set a competitive price.
Right. And for older investors, selling can sometimes mean unlocking a significant amount of equity, which could then be reinvested or used to fund retirement.
So it's this cycle of leveraging technology and making strategic decisions that can really enhance their financial security.
Exactly. And let's not forget about the social aspects of investing in real estate. Many people find community and connection through property investment. Attending local meetups or networking with other investors can create a supportive environment.
It's a great point. Being part of a community can also provide emotional support, especially when you're making big financial decisions.
Right. And when times get tough, like during economic downturns, having that support can make a world of difference. You're not alone in navigating those challenges.
So for someone listening right now, they might be wondering how to start leveraging these platforms more effectively.
Yes. And that's where we'll dive into some core strategies that can really help them make the most out of Zillow and Redfin.
I can't wait to get into that.
So let's dive into some practical strategies, shall we? I think one of the first things we should discuss is the 1% rule.
Oh, the 1% rule. That's a classic, right? It's pretty straightforward, too.
Exactly. So the idea is that the monthly rent you can expect from a property should be about 1% of the purchase price. For example, if you buy a property for $200,000, you should aim for at least $2,000 in monthly rent.
That makes sense. It's a quick way to filter out properties that might not be worth your time.
Right. But it's important to remember that it's just a guideline. Some markets might have different dynamics. In a high-demand area, you might find properties that don't meet that rule, yet they still make solid investments.
Yeah, I've seen that happen. It's all about context, isn't it?
Absolutely. And that leads us to the 50% rule. This one's about estimating expenses.
Oh, I like this one too. So the 50% rule suggests that you should expect to spend about 50% of your rental income on expenses, right?
Yes, exactly. So if you're bringing in $2,000 a month, you'd set aside around $1,000 for things like property management, maintenance, taxes, and insurance.
And that leaves you with $1,000 in cash flow?
Exactly. But, of course, you want to dig deeper than just that initial calculation. It's wise to create a more detailed budget, especially for unexpected costs.
Sure. And each property can have its quirks.
Right. You might find some properties need more upkeep than others, so always plan for those surprises.
Speaking of planning, let's talk about cap rates. They're another crucial piece of the puzzle, aren't they?
Definitely. The capitalization rate helps you understand the return on investment for a property. You calculate it by dividing the net operating income by the property's purchase price. So if a property earns $20,000 a year and costs $400,000,
You get a cap rate of 5%, right?
Exactly. And that's a good way to compare properties across different markets. Higher cap rates can indicate better returns, but they might also come with higher risks.
Yeah, I guess it's all about finding that balance.
For sure. And when evaluating deals, having a checklist can be super helpful.
A checklist? What do you usually include?
Well, I like to start with the basics: location, property condition, and market trends. Then I move on to financials, like the purchase price, potential rent, and of course, those expenses we just talked about.
That's smart. And what about financing options?
Financing can get tricky, but it's essential to understand your options. Conventional loans are a common route, but you might also explore FHA loans, which allow for lower down payments.
Right, and for people over 40, maybe they have more equity in their homes that they could tap into?
Absolutely. A cash-out refinance can be a solid option if someone wants to leverage their existing home equity to invest.
And I imagine that opens up a lot of possibilities for them.
It really does. But it's crucial to evaluate your risk tolerance before going down that road.
So what about the different property types?
Great question. Single-family homes are often the go-to for first-time investors. They're generally easier to manage, and there's a strong demand for rentals in that category.
But then there are multifamily units too, right?
Yes, multifamily properties can provide a higher cash flow, but they also come with more complexities, like dealing with multiple tenants.
And what about commercial real estate?
That's a whole different ballgame. Higher potential returns, but also higher risks, and usually a longer lease term. It's essential to be well informed before diving in.
I can see how that would require a different level of expertise.
Exactly. And then there's also the importance of market research. Knowing your local market is crucial.
So how do you go about that?
Well, I recommend using platforms like Zillow and Redfin, not just for listing properties, but to gauge market trends. Look at things like price per square foot, rental rates, and how long properties are staying on the market.
So you're saying it's about looking at the bigger picture?
Yes, and don't forget to check out neighborhood factors like schools, crime rates, and upcoming developments. Those can really affect property values.
That makes total sense.
And let's not overlook networking. Connecting with local real estate agents or attending seminars can provide invaluable insights.
Right. Learning from others' experiences can save you a lot of headaches.
Exactly. And, of course, we can't forget about the emotional side of investing. It's easy to get caught up in numbers and forget about what feels right for you.
So true. It's important to trust your instincts, too.
Absolutely. Now, speaking of pitfalls, it's essential to discuss some common traps that investors can fall into. You know, Sarah, one of the biggest pitfalls I see with investors, especially those who are just getting started, is over-leveraging. It can seem tempting to use as much borrowed money as possible to maximize potential gains, right?
Absolutely, Mike. It feels like you're playing a game, and the more you leverage, the more you can win. But what happens when that goes wrong?
Well, I had a client once who was really excited about a property in a hot area. They took out a substantial loan, thinking the value would only go up. But the market took a dip. Suddenly, they were underwater on their mortgage and had to scramble to cover the payments. It can be a nightmare.
Wow, that's tough. So how can someone avoid that situation?
First, I'd say know your limits. Don't stretch yourself too thin. It's crucial to do a thorough analysis of the property and the market. And remember to consider your own financial buffer. If things go sideways, can you still cover your costs?
That makes a lot of sense. And speaking of costs, I think a common mistake is ignoring cash flow. Right?
Yes, I can't stress this enough. I've seen investors so focused on appreciation potential that they overlook whether the property actually generates positive cash flow. There was another case, where an investor bought a multifamily unit thinking it was a gold mine.
But it wasn't?
Exactly. They didn't account for vacancies or maintenance costs. They were just barely breaking even, and then a major repair came up. It quickly turned into a financial strain.
So keeping an eye on cash flow is key. What about tenants? I imagine that can be a whole other challenge.
Oh, definitely. Bad tenants can wreak havoc on your investment. I remember one investor who was so eager to fill a vacancy that they didn't do proper screening.
Uh-oh, and how did that turn out?
Well, the tenants ended up causing damage to the property, and they weren't paying rent on time. It took months to evict them, leaving the investor in a really tough spot, both financially and emotionally.
That sounds exhausting. So what should investors do to avoid bad tenants?
First, take tenant screening seriously. Check references, credit scores, and rental histories. It might take a little longer to find the right fit, but it's worth it in the long run. Also, trust your gut. If something feels off, it probably is.
Great advice. Now, what about timing the market? I've heard a lot of people say you should wait for the right moment to invest.
That's another common pitfall. Trying to time the market can lead to missed opportunities. I had a colleague who waited for the perfect time for over a year and ended up losing out on great properties during that time.
So what's the takeaway there?
Well, it's better to focus on fundamentals rather than trying to predict market movements. If a property meets your investment criteria and the numbers work, jump on it. Markets will always have ups and downs, but a solid investment will weather those storms.
That's a great perspective. Now, hidden costs. I think many new investors underestimate those, right?
Absolutely. Hidden costs can really catch you off guard. I once worked with an investor who bought a property thinking the price was solid, but they didn't factor in property taxes, insurance, or potential HOA fees.
So they ended up spending much more than anticipated?
Exactly. They quickly learned that those fees can add up, impacting overall profitability. Always do your due diligence. Make sure to account for every possible cost in your budget.
It's like putting together a puzzle. You need all the pieces to see the whole picture.
Exactly. And if one piece is missing, it can throw everything off. Keeping track of those details can really save you from headaches down the line.
So if someone finds themselves facing one of these pitfalls, what's the best way to bounce back?
Well, first, assess the situation honestly. Identify what went wrong and learn from it. If it's a cash flow issue, maybe look into refinancing or adjusting your rental strategy.
That sounds practical. It's like turning a setback into a learning moment.
Exactly. And for those who are feeling overwhelmed, seeking professional help can be a great option. A good advisor can help you navigate the complexities and make informed decisions going forward.
That's solid advice, Mike. So in summary, what should listeners take away from this conversation about common pitfalls?
Well, keep your finances in check. Focus on cash flow, screen your tenants, be wary of trying to time the market, and always account for hidden costs.
And don't be afraid to seek help when you need it. It's all part of the learning process.
Absolutely. Real estate investing is a journey, and like any journey, there will be bumps along the way. The key is to stay informed and adaptable.
I love that. So as we wrap up this section, let's transition to some next steps listeners can take to enhance their investing strategy.
Yes, I think it's important to start with a solid education. Online courses, books, or even local workshops can be really beneficial.
And connecting with other investors or mentors can provide invaluable insights too, right?
Definitely. Networking can lead to opportunities and help you learn from others' experiences. Just remember to keep an open mind and be willing to adapt.
Great points, Mike. I'm sure our listeners are feeling empowered and ready to take the next steps in their real estate journey.
All right, so let's dive into some immediate actionable steps listeners can take right now.
Absolutely. I think the first thing we should talk about is how to use Zillow and Redfin effectively. Those platforms are gold mines if you know how to dig a little deeper, right?
For sure. One of the simplest tricks is to set up alerts for properties in specific neighborhoods. You can get notifications sent to your phone or email when new listings pop up. It's a great way to stay on top of what's happening in the market.
Yeah, and you can really tailor those alerts based on your investment criteria. Like if you're looking for multifamily properties, you can set that up specifically.
Exactly. And don't forget to use the map feature. Zooming in on particular areas you're interested in can help you spot trends that aren't obvious from just scrolling through lists.
Right. Also, when you're looking at a property, pay attention to the price history. It can give you insight into whether a property is appreciating or if it's been sitting on the market for a while.
Good point. And for those who want to go a bit deeper, I recommend checking out the Zestimate. It's not always perfect, but it can give you a ballpark figure of the property's value.
Oh, and let's not forget about Redfin's features. They have a hot home section that shows properties likely to sell quickly. If you see something there, you might want to act fast.
Absolutely. Now, aside from these platforms, there are also some great tools out there that can help you analyze deals, like the Bigger Pockets calculator.
Yes! That's a fantastic resource. It allows you to input all your potential expenses and income so you can see if a deal makes sense financially.
And there's Deal Check too. That one's user-friendly and helps you analyze investment properties on the go. You can even compare multiple properties side by side.
Speaking of analysis, Rentometer is another tool worth mentioning. It helps you check rental prices in your desired area to ensure your projections are realistic.
Definitely. And if you have access to your local MLS, that's a huge advantage. It gives you access to the most accurate and up-to-date property information.
For sure. Getting into those local real estate meetups is also a great way to connect with other investors. You can share tips and learn from each other's experiences.
That's a great habit to start. Even if you only analyze one deal a week, it can build your skills and confidence over time.
Right. And if you're feeling overwhelmed, just remember to start where you are. Even small steps make a difference.
Absolutely, and it's about building that consistency. Maybe set a goal to read one book or listen to one podcast a week on real estate investing.
Good idea. There are so many amazing resources out there. I really like the Bigger Pockets podcast for practical advice, and Real Estate Investing for Dummies is a solid book for anyone just starting out.
Yeah, and if you're looking for something more advanced, The ABCs of Real Estate Investing by Ken McElroy is a great read. It dives into strategies you can use at different stages of your investing journey.
And remember, You don't have to know everything right away. Just take it one step at a time, keep learning, and don't hesitate to ask questions.
Exactly. Building those connections at meetups can also lead to potential partnerships down the line, which can be incredibly beneficial.
Oh, for sure. And as you grow your network, you might find a mentor who can guide you through the process. That can be a game changer.
Very true. So whether it's using those platforms, analyzing deals, or engaging with your local community, there are plenty of ways to get started today.
And it really just comes down to taking that first step. You don't have to have all the answers, just a willingness to learn and grow.
Well said. So those are some practical first steps. Now let's bring this all together. Well, it's been quite the journey through the world of Zillow and Redfin today, hasn't it?
Absolutely. I think some key takeaways really stand out. First, using those filters on Zillow and Redfin can save you so much time, right?
Yeah, definitely. It's all about narrowing down your search to find the best investment opportunities that fit your goals.
And, the importance of analyzing historical data. I loved how you explained that, Mike. It really helps to get a feel for the market trends, doesn't it?
Exactly. Knowing what properties have done in the past can guide you in making informed decisions for the future.
Also, the idea of using the sold tab. I think a lot of investors overlook that. It gives you real insights into what's actually happening in the market.
Right. That's such a valuable tool. It's not just about what's for sale, but what people are actually paying. That's crucial for negotiations, too.
And, well, the importance of consistency and checking these platforms regularly. Staying updated can really make a difference in spotting those great deals.
For sure. And remember, folks, building wealth through real estate is a marathon, not a sprint. It takes patience, persistence, and a willingness to learn.
Exactly. So if you found some value in today's episode, please like, subscribe, and share your biggest takeaway or any questions you might have in the comments. And don't forget to share this with someone over 40 who's looking to invest in property. They might just appreciate it.
Yeah, we'd love to hear from you. And next time, we'll dive into Rentometer and Rent Range Mastery. You won't want to miss it.
That's going to be a great one. Thanks for joining us today. We're excited to continue this journey with you.
Take care, everyone.
Bye for now.